On the final trading day of the financial quarter, major stock market indices did something notable. After trending downward, the numbers violently reversed their momentum, surging upwards by hundreds of points in a single afternoon. Inflation is stubborn, interest rates remain high, and global tensions are escalating. The underlying economic data points negative, leaving retail investors to wonder what exactly drove the numbers higher at the 11th hour. Veterans who have survived decades in the market see this entirely differently. They look at that specific timing, the final trading day of a quarter, and recognize that a sudden broad market rally often has more to do with the calendar than economic health. Basing a financial strategy on a single day of green arrows is a mistake. It leaves you exposed to the structural incentives of the very institutions managing the market. This animated diagram illustrates a practice known as window dressing. Notice how the portfolio's value remains relatively steady until it approaches the vertical line marking the end of the quarter. Right there, fund managers buy up top-performing stocks, generating a surge in volume to lift the closing prices of their holdings. They do this to inflate the numbers right before generating quarterly reports for their high-net-worth clients. It creates a temporary appearance of stability and, crucially, triggers performance-based payouts for the managers before the stock prices inevitably drift back down. Since the broad market index can be swayed by insiders chasing a quarterly benchmark, the top-line numbers are compromised. To gauge the actual health of the economy, you have to bypass the index and examine the hard cash flows of individual corporations. Consider Nike. As a global corporation selling physical goods across every continent, they serve as a barometer for trade and consumer spending. This bar chart directly compares a surging macro market index against Nike's most recent quarter-over-quarter revenue. While the broader market shows growth, Nike's top-line revenue has flatlined. Beneath that flat revenue, the internal financials are degrading. Their cost of sales is rising, which immediately eats into their gross profit margins. At the exact same time, their operating overhead expenses are climbing. That compounds the crisis, squeezing their actual profitability down to a fraction of what it used to be. This internal decay is driven by external pressures. Global energy costs remain elevated, making it significantly more expensive for legacy brands to manufacture goods and move them around the planet. And when those increasingly expensive products finally arrive, they aren't selling. Consumer demand has stalled out in major international geographies, specifically across China and Europe. Rising costs and frozen demand are shrinking the world's largest consumer empires. If the companies that make up the real economy are contracting, the broader market rally is a facade. But there are exceptions to this contraction. Take E.L.F. Beauty. While legacy brands are struggling to break even, this lean, domestic company has managed to grow its revenue for 28 consecutive quarters, ignoring the global chaos. They benefit from a specific economic defense mechanism. When household budgets tighten, consumers don't stop buying completely. They abandon premium global brands and trade down to cheaper alternatives that still fulfill a daily need. This comparative visualization shows exactly how E.L.F. capitalizes on that shift. They undercut legacy competitors on retail pricing, yet maintain 70% gross profit margins, a combination that traditional retailers simply cannot match. Capital flows towards efficiency. Investors are pulling money out of sprawling international legacy brands and pouring it into low-cost domestic operations. Unpredictable variables will continue to cause short-term chaos. Oil prices will fluctuate, geopolitical tensions will flare, and political figures will dominate the news cycle. Wall Street institutions rely on this chaos. They use the daily panic as cover to manage indices for quick profits, completely disconnected from the actual production of goods and services. True wealth is not built by gambling on what the market will do over the next 10 days. It is built by identifying resilient companies and holding them for the next 10 years, letting their underlying cash flows compound through the noise. As global supply chains fracture and legacy brands crack under the pressure, passively buying a broad market index fund is no longer a safe harbor. You have to own the specific, lean domestic companies that are capturing market share. Financial power requires seeing through the Wall Street mirage and investing in the underlying reality of the companies themselves. When the stock market violently spikes upwards out of nowhere, you might assume the broader economy is booming. In reality, you are often looking at a carefully engineered mirage. Financial elites can manufacture these massive rallies, entirely detached from the actual economy. The easiest place to spot this artificial surge is on the very last day of a financial quarter. Suddenly, without any major economic news, popular tech stocks on the Nasdaq will inexplicably shoot up 4, 5, or 6% in hours. Wall Street has a specific, fully legal practice for this called window dressing. It is a deliberate, highly incentivized maneuver designed to make a mutual fund or institutional portfolio look much stronger before the reporting period closes. This timeline shows the mechanism. Fund managers sit on cash, buying top stocks at the last possible second. This sudden pressure artificially inflates closing prices on the quarter's final day. They do this to present attractive portfolios, keeping clients happy and securing lucrative bonuses. Because this legal manipulation inflates the macroeconomic picture, you cannot rely on the top-line ticker tape to tell you the truth. To find where wealth is actually being generated or lost, you have to look past the surface numbers and investigate specific individual business fundamentals. Let's look at a legacy American consumer brand to see how a company actually operates underneath the market hype. Consider a powerhouse like Nike. On paper, Nike beat Wall Street's minor earnings per share estimates, but their actual core quarterly revenue has completely flatlined. This flat revenue meets a toxic combination underneath the hood: shrinking gross margins down to 40%, while operating overhead expenses rise by 3%. A major driver of this decline is dropping international demand. In the European market, recent quarterly growth slumped to a mere 2%. Meanwhile, their critical footwear segment in China has faced severe, double-digit negative headwinds throughout this past year. When a legacy titan is exposed to multiple global markets and burdened by bloated overhead costs, it becomes highly vulnerable to international economic slowdowns. The broad stock market might rally on a given Tuesday, but a company bleeding margins will steadily lose its value. While the legacy brands lose their footing, a new breed of hyper-efficient domestic market disruptors is quietly absorbing the consumer wealth those older companies are leaving on the table. Look at E.L.F. Beauty. In an economy where massive corporations are struggling to maintain flat sales, E.L.F. is a complete anomaly. They have achieved an astonishing 28 consecutive quarters of revenue growth. Their advantage comes from a highly specific business model. They manufacture premium quality cosmetics that rival high-end competitors, but they intentionally undercut legacy pricing. When consumer budgets tighten, shoppers trade down to E.L.F. without feeling like they are sacrificing quality. This comparative gauge visualizes a massive financial gap. The typical U.S. consumer company operates with gross margins around 41%. Because E.L.F. moves incredible volume with minimal overhead, they sit at a staggering 70% gross margin. They pair those margins with current demographic dominance. Recent surveys show E.L.F. is the most purchased brand among both Gen Z and the emerging Gen Alpha, audiences that are historically harder for legacy brands to capture and retain. They also command premium shelf space. E.L.F. is recognized as the most productive company in beauty retail, and associated influencer brands like Hailey Bieber's Rhode skincare line now sit at the absolute top of Sephora's rankings. They are pushing out the old guard. By combining low prices, 70% margins, and command over young consumers, E.L.F. has built a needs-based juggernaut. This structure allows them to capture trade-down shoppers when the economy cools, providing a level of resilience that legacy retailers lack. Every day brings a new chaotic geopolitical threat. Middle East conflicts create unconfirmed panic, and investors constantly worry that energy costs might send oil spiking to $150 a barrel, crushing the consumer. Reacting to these 10-day or 10-week panic cycles is a losing game. Veteran investors like Warren Buffett brush off short-term sell-offs because they know true wealth generation requires focusing strictly on 10-year timelines. This conceptual barbell graphic illustrates an actionable way to insulate your portfolio. It's called the barbell strategy, a method of capturing wealth across a volatile, divided economy by investing in two absolute extremes. You balance the weights. On one side, you hold high-growth, low-end disruptors like E.L.F. Beauty. On the other, you hold premium, high-end legacy brands like Estee Lauder. capturing a consumer segment that historically maintains its luxury spending habits longer than the general public. The masses will always be distracted by daily news panic and Wall Street's end-of-quarter illusions. True wealth belongs to those who look past the immediate market fluctuations and invest entirely in long-term business fundamentals. If you want to understand the real logic behind the market and protect your wealth for the next decade, subscribe to Dollar Logic USA. We'll see you in the next one.